Actually, hedge funds are quite popular, and in some cases, their managers are treated like celebrities, because of how popular these funds could be. So in this video, I want to I want to talk about understanding hedge funds, the strategies involved, the benefit as well as the risk. So hedge funds are a type of investment funds that pulls capital from accredited or institutional investors and uses a variety of strategies to earn active returns or alpha for their investors. That emphasis on alpha is very, very important. They are designed to beat the markets to obtain that extra profit for their sophisticated investors. So here are an overview of the this particular strategy. Let's look at the key features uh, of a typical hedge fund. Number one is flexible investment strategies. That's flexibility when it comes to the investment strategies. Hedge funds employ a wide range of strategies, including long short equity, arbitrage, global macro, and events driven investing, among others. This flexibility allows them to capitalize on various market conditions. They are they are versatile. They are quite versatile, and they can utilize any strategy they feel will give them that alpha, that outperformance, which their investors have come to rely on or expect from these managers. Number two is a use of leverage. Hedge funds often use leverage, that's they borrow money, to amplify their potential returns. This can lead to higher profit, but also increases the risk of significant losses. Generally, they are highly leveraged, and when they make profit, it amplifies their profits. And if they sustain losses, it will equally, uh, worsen the entire situation. Number three is diverse asset classes. Hedge funds can invest in a variety of assets, including stocks, bonds, commodities, currencies, derivatives, and real estate. So they have that wide kind of assortment of instruments they can invest in. Number four is active management. Hedge funds are actively managed, with portfolio managers making frequent and complex trading decisions in an attempt to outperform the market. They always attempt to outperform the market. Unlike index funds, hedge funds are designed to deliver that alpha to outperform the markets by every means possible. And so you have number four or number five, high fees. Hedge funds typically charge high fees, including a management fee, usually 2% of asset under management, and a performance fee, often 20% of profits. That's where the term 2 and 20 came from. 2 and 20. They will charge 2% of the capital under management, then they will charge 20% of the profits. If they have $1 billion under management, they will charge $20 million as management fee. And if they make a profit of $200 million, they will charge they will charge 20% of it. That should be 4 million thereabout. 200 million, 10% is 2 million, is 20 million. 20% is 40 million. They charge $40 million out of the profits as their performance fees. That's interesting. Number six is accredited investors only. So due to their complex strategies and higher risk, hedge funds are generally only open to accredited investors, those who meet certain income or net worth threshold. Usually, all those who are worth $1 million and above are considered accredited investors. They are high net worth individuals. I think that should be the criteria, if I'm not mistaken. The benefit here is number one, potential for high returns. Hedge funds aim to deliver high returns by exploiting market inefficiencies and using sophisticated strategies. They are highly skillful. They are smart analysts, managers, and individuals that are there to deliver that outperformance. Number two is diversification. By employing a variety of strategies and asset classes, hedge funds can provide diversification benefits, potentially reducing overall portfolio risk. They invest in a wide variety of asset classes. And so, a particular asset underperforming will not really affect them that much because of their level of diversification. Number three is absolute return focus. Many, many hedge funds focus on achieving positive returns regardless of market conditions, which can make them attractive, in volatile or bear markets. If they want to, they want to obtain a result that is more than what the overall market could deliver. So they're not really benchmark against any, they just want to obtain that absolute return. Number four is customization. Hedge funds often tailor their strategies to a specific investor needs or market condition, offering a level of customization not typically found in traditional funds. They tailor their strategies to meet a particular, to obtain a particular outcome. So we have the drawbacks, the disadvantages here. Number one is high risk. The use of leverage and complex strategies can lead to significant losses, especially in volatile market. Number three is lack of liquidity. Hedge funds often have lock-up periods during which investors cannot withdraw their funds. Even after the lock-up period, redemption may only be allowed at certain times. Example, quarterly. They have a lock-up period. If you are invested in it, if the lock-up period is 5 years or 3 years, you cannot seek for redemption. You cannot redeem you cannot, withdraw your money. You cannot, divest from the fund. Before then, you have to stay through, that period with the fund. And there's this, number two, lack of liquidity. Apart from the lockup period, these make sure that the lockup period here, ensures a kind of illiquidity. You cannot very easily buy or sell. You cannot easily sell and recoup your money, because your money is locked up for a specific number of years. Number three is high fees. High fees. The combination of management and performance fees can significantly reduce net returns to investors. We spoke about 2 and 20, so the fee there is quite high. Number four is limited transparency. Hedge funds are less regulated than mutual funds and other investment vehicles, which can result in less transparency regarding their strategies and holdings. They're not as regulated as other funds. So there's the issue of they not being as transparent as what is obtainable in a typical mutual fund. Number five is market dependency. Despite aiming for absolute returns, many hedge funds can still be impacted by broader market trends, especially if their strategies don't perform as expected. Although they seek alpha, but at the same time, the market has a way of interfering with their overall returns. So we want to look at common hedge fund strategies. What are the common strategies hedge funds usually employ? they have this long short equity involving taking long positions in stocks, expected to increase in value, and then short position in the stocks that are expected to decline. Number two is global macro. They invest based on macroeconomic trends such as interest rates, currency movements, and geopolitical events. They invest, like worldwide, invest outside their geographical boundaries. There's a number three here, event driven. They focus on opportunities arising from corporate events such as merger, acquisition, or bankruptcies. Number four is arbitrage. They seek to exploit price inefficiencies between related securities, such as convertible bonds and the underlying stocks. They can invest in convertible bonds, and that is they can very easily convert the bonds to stocks if that particular action will make them to profit, will then guarantee them profit. Number five is management, manage future. You know, they utilize futures, contracts to speculate on the direction of commodities, interest rates, and currencies. Actually, interestingly, in my country, we don't really have we don't trade, in futures. We don't utilize options. We don't equally, you know, deal in futures. It's plainly, stocks and probably some other commodities. Number six is distressed securities. So they invest in the bonds or equity of companies in financial distress, often with the expectation of restructuring or turnaround. This is a kind of vulture investing. When a company is undergoing distress, they invest in those companies so that they can see how it could be turned around, and then they will benefit from the restructuring if all things being equal. Hedge funds can be a powerful tool for sophisticated investors looking to diversify their portfolios and achieve higher returns, but they come with significant risks and complexities that must be carefully managed. That's why it is reserved strictly for sophisticated investors who know what they are doing. Please subscribe to this channel and like this video.